There we go. Should be all good. There we go. Perfect. Let me just open up the chat. Here we go. Copy link. Welcome to those who have just joined. Day 3. Boom. There we go. Let me move this down here. Make sure audio's all good. Yeah, seems to be. Hello, Johnny. Hello. So Bootcamp day 3. Bit of an interesting time to do the live. Those who are watching at a later point, welcome, and those who are here now, hello. So yeah, very busy day today. I'm gonna try and I am gonna get every single lesson. I'm gonna do a lesson every single day throughout December. Sometimes, depending on other things which are going on, I will have to do them either earlier or later, but they will be done, a lesson every single day throughout December. So hello to everyone who's just joining now. These lives and the bootcamp lives are going to be more of a lecture style. So it's going to be me reading through the content, and basically after each section, I'm going to open up the floor to you guys. If you've got any questions, then just please let me know, and we'll clear up anything there. And then also the lives which I normally do on a night, they're the ones which are a lot more, chill. Just having a catch up, having a conversation and going from there. So this one's more of a lecture style, just straight, raw, unfiltered content. And the lives I normally do on a night, which I'll still do, they're more laid back, chill. Let's just have a catch up, and let's nail down some nice levels for tomorrow. So hello. Hello Bella, Johnny, K-Mops, Hydro, hello. So on this one, and something else which is going to be cool for tomorrow's section of the bootcamp is I'm going to be adding a lot more pictures and visual stuff, and changing around the quiz. You only sort of learn how these things, like how to properly convey information by conveying it. So I've definitely worked out a few ways we can optimize this to make it as engaging as possible for you, so the information just really sticks. Unfortunately today has just been absolutely non-stop, so I haven't had time to do that, but that will be done for tomorrow's live. And so yeah, it's just going to get better and better. So yeah. So let's just get into it. So lesson 3, if you do want to catch up on the previous lessons, there is a playlist on YouTube titled Bootcamp. When you go onto the YouTube channel, you click playlist. There's a bootcamp on there going through lesson 1, lesson 2. Now we're on lesson 3, which is market structure and dynamics. So this bootcamp, by the way, is included inside the private group completely for free. Literally breaking down everything trading. You can see it here in extreme detail. Right now we're on market structure and dynamics. So there's an overview. We're going to skip straight to the introduction. The modules which we're going to cover in this live are going to be introduction, resource material. We'll glance over the summary and then we'll get into the quiz. In the quiz, definitely make sure you've got like a pen and paper or somewhere to write down your answers, and then we'll go over the answers together, and definitely keep me updated with how you get on during the quiz. So let's get started with the introduction. As far as strategy, Johnny, you can ask that on the other lives I do, the ones which aren't the bootcamp lives. Ask me any questions you've got regarding my system, and I'll happily go into as much detail as required on the system. More than happy to do that. But on the bootcamp, it's just going to be straight, unfiltered, raw information. And again, they're going to get better and better as we go on. Definitely found a few ways we can optimize and improve it to, again, make it more engaging for you, so the information really sinks in, which is, I think, a main point I really want to drive home. So let's get straight into it. So introduction, market structure and dynamics. So welcome to one of the most important lessons in your trading education. You might be tempted to skip past this thinking it's just theory, but understanding market structure is what separates traders who let me just separates traders who consistently read price action correctly from those who constantly get confused by random movements. This lesson will fundamentally change how you view the charts. Okay, here's what most beginners see when they look at a chart. A confusing mess of candlesticks going up and down with no apparent logic. They try to apply indicators, draw random lines, and hope for the best. Sometimes it works, often it doesn't, and they never really understand why. This is because they're missing the foundation. They don't understand the underlying structure that drives all price movements. Makes sense? Let me know if it, after each section, we'll sort of take a little bit of a breather and make sure it all sinks in. I think we'll keep going on this part though. So markets aren't random. They're driven by the interaction of buyers and sellers. And this interaction creates identifiable patterns and structure. When you understand these structures, you can read what the market is actually doing rather than guessing. You'll see when buyers are in control, when sellers are taking over, when the trend is likely to continue, and when it's about to reverse. This isn't magic, it's simply understanding the mechanics of how markets work. Very important. Let me just make sure this is all good. Yeah, very, very, very important. You need to understand how markets are actually working. They're not just random price movements up and down. And something which is really, really important, which I'd like to touch on from that particular section there, is a lot of people, they don't really think about what's going on inside the candles. At the end of the day, it's buyers versus sellers. Understanding what the buyers are seeing and understanding what the sellers are seeing, being able to see both sides of the argument is very, very important. And a very simple explanation is, there's two sides to every story, and there's two sides to every market. Okay, there's buyers and the sellers. So understanding both points of view is very important. Okay, the buyers are buying for some reason and the sellers are selling for some reason. So understanding that can be very, very, very important. So let me know if that sounds good so far, guys, and then we'll continue it, and then we'll keep going. Hello, Eve. Hello, Ollie. Just the audio be rewatching properly another time. Nice, Andy. All good, all good. These first few lessons in the bootcamp are just the foundations. We'll get into a lot more sort of specifics later on in the bootcamp. And of course, if you've got any questions regarding my system and anything like that, systems that deviate from what's covered in the bootcamp, then you can ask those on the normal lives. I go live near enough every single night from Sunday to Thursday, 8 p.m. And you can ask literally any trading question on there, and I'll happily go into detail on it. So let me know if that sounds good. Perfect. So, in this lesson, we're going to demystify concepts like support and resistance, supply and demand zones, market phases, ranging versus trending, and the critical concept of liquidity. You'll learn why price doesn't move in straight lines, why it creates higher highs, higher lows in uptrends, and why understanding swing points is crucial for trade planning. We'll explore how institutional traders, the big players who move the markets, think about structure, and how you can use this knowledge to your advantage. But we're not just learning theory for the sake of it. Every concept you learn here has direct practical application. Very important. Understanding support and resistance tells you where to place stops and targets. Recognizing supply and demand zones show you where best to place entries for trades. Identifying market phases prevents you from using a trending strategy in a ranging market, extremely important, and vice versa. Reading market structure helps you stay on the right side of momentum rather than fighting against it. And this could not have been better demonstrated during the past few weeks on gold. So there's a couple important points from that. So one of the important points is there's a lot of systems which work extremely well during a trending market, but they get messed up during a ranging market. And vice versa. There's a lot of systems that do very well during a ranging market, but not too well during a trending market. And that's where you need to learn, you need to build up the ability to identify what type of market we're in, so you can use the system which is best suited for that market, or edit your system a bit. For example, me personally, over the past few weeks when gold's been in that nice range and we've been catching literally every high and every low, I'm very much on the 15 to 30 minute time frame, identifying strong levels and near enough every single one was absolutely flawless. Then when we broke out and we were heading directly to the upside, I'm just looking for retests. Like the retests for today before that huge move up. I'm just looking for retests. Okay, I'm just looking for buys. If gold's moving up, why? I don't want to get in the way of that moving bus. Gold is a big bus. Okay, I don't want to get on the other side of that. And so I constantly see gold having a huge move up. And then a lot of people are like, when are we selling? When are we selling? Why not just, zoom in, look for some areas of support and get in with that trend? Chances are it will continue. Okay, so not being on the wrong side of the market is important as well. So let me know if that makes sense, and we'll continue into the next part. Perfect. Let me know if that makes sense, guys, and we'll continue into the next part. And for those who are just joining us now, this is day 3 of the bootcamp, where basically, excuse me, this is going to be just raw, unfiltered, straight trading knowledge. And then the lives we do later on in the night, which aren't the bootcamp lives, they're a lot more chill, relaxed, ask any questions, and I'll happily go into detail on them. This is more lecture, that's more chill. Makes sense. Perfect. By the end of this lesson, you'll view charts completely different. You'll see structure where you previously saw chaos. You'll understand why price moves the way it does, and you'll be able to anticipate future movements based on current structure. This foundation is essential for everything that follows in this course. Technical analysis, strategy development, and trade execution all depends on your ability to read market structure correctly. So approach this lesson with focus, take notes, draw on charts, practice identifying structure on your chosen market. This is one of those rare topics where an hour of proper study will save you months of confused trading and unnecessary losses. Let's build your understanding from the ground up. So being able to identify the market structure on your charts, higher highs, higher lows, everything like that is very important. And it just means when you come to the chart, you've got something to base your trades off. It just creates that structure which is needed. You don't just chuck up a building. You put the pole's called, the scaffolding. You put the scaffolding up first, then the building, goes up. Okay. If you would just try and build a building with no scaffolding, that'd probably be really, really tough. Okay. The scaffolding goes up first, the structure of the building, the outline of the building, then the building goes up. Okay. So let's continue. From introduction, we're going to go into resource material. So resource material, market structure, and dynamics. Let me know if we're all good so far, guys, and we'll continue throughout the rest of this. Perfect, makes sense. Sounds good. I need to keep drinking water. I've got a busy night ahead. This is this is gonna be fun. Boom. So. And if you do have any questions and you're watching this at a later point, please don't hesitate to drop a comment in the comment section below. Ask any questions you may have, and I'll come back to them on the YouTube and get them answered. So, market structure is the framework that describes how price moves and organizes itself over time. At its core, market structure is about identifying swing points, the peaks and troughs that price creates as it moves. These aren't random. They're created by the shifting balance between buyers and sellers, and they tell you who's in control at any given point. So throughout today, buyers have clearly been in control as we've been rocketing up. When you can read structure, you can anticipate where price is likely to go next, where key decision points exist, and where the best trading opportunities appear. Very important. And just being able to identify, okay, we're forming higher highs and higher lows here. Chances are price is going to continue to move in that direction. If we're forming highs and then lows and then highs and then lowers and, we're just all over ranging, chances are we're going to stay in that range. It's as very simple as, it sounds as simple as that. And at the charts, sometimes keeping it simple is the way to go. If price is constantly going to new areas, chances are it will continue to go to new areas. If price is staying in the same general area, it's more likely to stay in that same general area. And so yeah. Let me know if that makes sense, and then we'll continue on to the next part. Never thought I'd be hiding in a booth to watch trading videos, but I find myself looking forward every day. Just wanted to say thanks. All good, Ali. I appreciate that a lot. And I don't know how these bootcamp videos will go down. These are just like raw, straight knowledge. The normal life, definitely very different to our normal lives. Our normal lives, we talk about all sorts of crazy stuff, and I really enjoy that. But I also, I enjoy this, and I see the value in this. This is, for those who just want that straight study, this is perfect for them. And in this community, we want to create an environment where anyone, no matter the mentality, has the opportunity to grow and learn as a trader. So let's continue. In an uptrend, you'll see a specific pattern: higher highs and higher lows. Each swing high is higher than the previous swing high, and each swing low is higher than the previous swing low. This pattern tells you that buyers are in control. Even when price pulls back, buyers step in at higher levels than before, preventing price from falling as far. We'll get up a chart and we'll go over this. This creates the staircase pattern of an uptrend. As long as this pattern continues, each higher high and each higher low, the trend is intact, and you should be biased towards looking for long opportunities. So we'll pull up the chart here. This was really nice. We'll go on to the lower time frame just to make it easier. And we can see here that price formed this staircase pattern. So a low, a high, a low, a high. Chances are price is going to continue in that direction. Okay. And then when we broke this low, this is the next part. So we broke this low here. So now we're looking, now it's in bearish market. So we've got a high, a low, a high, a lower low. Now we're forming the lower high. Okay. So basically it just shows a staircase. Okay. So you can mark out a high, mark out a low, mark out a high, mark out a low, mark out the high. Excuse me. As long as the highs are higher than the previous high and the low is higher than the previous low, you're in an uptrend. Let me know if that makes sense. And we'll move on to the next part. Actually, we'll just go into the next part because it links in. Conversely, a downtrend shows lower highs and lower lows. Each swing high is lower than the previous one, and each swing low is lower than the previous one. This pattern indicates sellers are in control. Even when price rallies, sellers step in at lower points than before, preventing price from rising as far. The trend remains bearish as long as this pattern continues, and you should be biased towards looking for short opportunities. Breaking this pattern when price makes a higher low in a downtrend or a lower high in an uptrend often signals a potential trend change, or at a minimum a period of consolidation. So again, on the chart, to identify market structure, all you're doing is you're looking for lows, then highs, lows, highs, lows, highs, lows, highs. And a great, I really heavily encourage everyone to, where's this at? I really heavily encourage everyone, when you're going through these sections of the bootcamp, pause it every now and then, go onto your chart and mark those particular things up. So with regards to higher highs and higher lows, go onto your chart, just draw high highs and high lows, slap it in the Discord or message me them and see if you got it right. That's the best way. Instead of thinking, is this right? Is this wrong? I'm going to look at this video. I'm going to look at this video. Just try it on the chart, send it to someone who knows if it'll be right or not, and see if it's right. Okay? Let me know if that makes sense, guys, and then we'll move on to the next one. Boom. There we go. Let me just make sure this is all good again. Perfect. There we go. So let me know if that makes sense, guys, and we'll move into the next part of it, which is on about supply and demand. Well, we've got 2 more sections here. Then we'll go on about supply and demand, which is a very popular concept nowadays. I need to make sure I keep drinking. With these bootcamp sections, I've never spoke so much in my life. Okay, let's continue. But here's what beginners misunderstand. Support and resistance aren't exact prices. They're zones. Price rarely bounces exactly at £1.20. It might bounce at £1.1995 or £1.2008. This happens because different traders have slightly different ideas of what the level is. And because the market is dynamic and messy, when you're marking support and resistance, think in terms of zone rather than perfect, precise price. A 10 to 20 pip zone is more realistic than trying to pinpoint the exact pip. This is very important. Zones, even when it comes to trend lines, everything's zones. The market's made up of a lot of emotion, okay? Things are everywhere. So you need zones rather than exact prices. Chris, to mark up market structure, any time frame. Time frames are just fractals of each other, so everything works the same. So if you're trying to figure out if you're getting market structure right, just any time frame, doesn't matter, any time frame, just mark up the market structure and yeah. I don't put too much weight on time frame. If I want more information, I'll zoom in. If I want less information, I'll zoom out. It was a very difficult thing for me to when I was starting trading to get into that mentality of, okay, there's no golden time frame. I'm not just going to use the 15-minute. I'm not just going to use the 12-minute. I'm not just going to use the 6-minute. I'm going to be fluid with my time frames. I'm going to, make it a zoom feature. If I want more, I'll zoom in. If I want less, I'll zoom out. I think it's a really good mentality and habit to build up. Okay, let's continue. Support and resistance also switch roles when broken. When price breaks above resistance and holds it, that former resistance often becomes new support. Why? Because traders who sold at that resistance and got stopped out now see that level as strong buying interest, the level that launched the breakout. Traders who miss the breakout watch for price return to that level as a second chance entry. This role reverse is one of the most reliable phenomena in technical analysis and creates excellent trading opportunities when identified correctly. As we saw yesterday, all of these concepts as well, every single one of them, I actively use on the chart, and you can see that in the level which was marked up yesterday. Was it yesterday? Yeah, this one here. So previous support, sorry. We formed support here, a low. When we broke that low, so again, we formed this low here. We were in an uptrend, low, high, low, high. When we broke this low, I marked this level up in advance because we broke this low, and I anticipated us to flip that low into resistance. Okay, so this is why resistance was marked there. It had other confluences, but that's the biggest one. So you can see, although it sounds, like just words on a screen, you can see I actively use that level to make money and pull money out the charts. Okay, let's continue. No jump. I ain't got time to get the jumper. All good, Chris. Okay, let's continue into supply and demand zones. So, while support and resistance identify areas where price has reversed multiple times, supply and demand focuses on areas where strong impulses moves originated. This comes into something which I just showed you as well. These are quantifiably different concepts, though they're often confused. A demand zone is an area where buyers entered so aggressively that price shot up sharply, leaving behind an imbalance. A supply zone is where sellers entered so aggressively that price dropped sharply. These zones represent institutional interest, big players moving size, and they often provide excellent high probability trade locations. So, This is something I very much often talk about, and it's when a level is broken with substantial volume, the point where we broke the level from is an area of supply or demand, exactly like we had here. So when we break a level with substantial volume, chances are we're going to get a reaction there when we come back to it. It's a very, very good concept. So yeah. Ollie, they're all interlinked. A lot of the concepts you'll hear nowadays in the trading space, they're all just repackaged versions of each other. That's all it is. So yeah, that's really all. Especially the SMC, supply and demand, ICT space. It's all just repackaged. I will keep these in mind, but I don't actively trade on them. Again, I use volume levels, Fibonacci, trend lines, everything like that to identify my areas of support and resistance. But other concepts and the broader trading space is important to understand, and it's good to just have that breadth of knowledge there. But they're all just repackaged versions of themselves, Ollie. Yeah, just with different names. A lot of them are based on concepts that have been around for a long time. But, you know, someone slaps a new name on it, making it sound really cool, and then they sell a course on it, and it makes a lot of money. That's basically how the trading world works right now, unfortunately. So, the key characteristics of a valid demand zone. Price was in that area only briefly. Quick accumulation. The move away from the zone was strong and impulsive, indicating institutional buying, and price hasn't returned to that zone yet. The zone is fresh. When price does return, there's a good chance the original buyers are still holding positions and may defend that area. Or other institutional traders see it as an area of value and step in. Fresh zones work better than tested zones because each test consumes some of the available orders at that level. This is something I've spoke about a lot on various different live streams. So if we come over here, if we think about an area of resistance in terms of like a line like this, every time price touches this line, we're soaking up some of the orders. So like, let's say there's 10,000 orders here. We go up, we take, 2,000 orders. We come back down. We go up, we take, another, let's say 3,000 orders. We come back down. This final time we go up, we take maybe 5,000 orders. There's no more orders left at that level. So what happens is we jump through that level and we have explosive move to the upside, okay? But this tells us that institutions and big traders were interested in this level here. So when we return to it, okay, we can anticipate some sort of a reaction. That's how I like to think of it, and I think that's a nice way of explaining it as well. Again, let me know if that makes sense in the chat, guys, and we'll continue. We'll continue here. Boom. I use the same as you and Jay. It just clicks for me better. Something nice to think about, though. Yeah, Ollie, I 100% agree. I think just keeping your breadth of trading knowledge, large, is really good. It's like, it's like you're on a football field and it's really foggy. Okay, yeah, you can still play football, but if it's the clearer the field, the easier it is to analyze sort of what's going on the pitch, and you can make better decisions. Okay, you can still play football, you can do very well, but it's better if it's not as foggy. And like I said previously, it's good to understand, what's going on. There's buyers and sellers in this market. It's good to understand, all sides of the argument. So I think this is part of understanding all sides of the argument. Although I trade different to this, it's nice to understand these points. We'll get into volume levels and Fibonacci later on in the bootcamp as well. We even get analogies. So supply zones work identically, but in reverse. Look for areas where price spent little time, then dropped sharply. These represent aggressive institutional selling. When price returns to these zones, particularly fresh ones that haven't been tested, you often see selling pressure re-emerge. The original sellers might add to positions, or new sellers might recognize it as an area where supply overwhelmed demand previously. The sharp move away from the zone is your evidence that serious order flow existed there. One critical distinction between demand zones are not the same as swing lows. Supply zones are not the same as swing highs. This is important. A swing low might be the result of a gradual grinding reversal. That's support, but it's not necessarily a strong demand zone. A demand zone requires that impulsive move away, evidence of institutional buying. Similarly, a swing high from a slow grinding top isn't a supply zone. It's resistance, but it lacks the signature aggressive institutional selling. Learn to distinguish between the two concepts because they're used differently in trade planning. So again, let me just move this here. I want to keep that on. But here we had this area here, and then we saw massive sellers here, massive sellers, huge seller pressure. So that is a demand zone basically. So consequently, on the upside here, we formed a high, okay, but it's not necessarily like we've kind of grinded to it, like it's kind of been slow. There's been no impulse move to the downsides, so that's not. So yeah, supply zone. Sorry. So yeah, let's continue. Does that make sense, guys? Let me know if that makes sense, and if you're watching this at a late point, let me know in the comments if it makes sense also, and then we'll continue. Let's make sure I'm staying hydrated. Everyone loves the analogies. That's brilliant. But yeah, let me know if that makes sense, guys, and we'll happily move on to the next part. For those who have recently joined us, we're going through day 3 of the bootcamp. This is just raw, unfiltered trading knowledge of everything you need in trading from A to Z. Okay, we've got 30 days. I'm going to be doing a bootcamp lesson every single day. The lives I normally do on a night are a lot more fluid, a lot more, relaxed, and I still will be doing those lives on night. But these lives are a lot more, fixed and to the point. Thanks, always helpful. Good. Okay, market phases, trending versus ranging. Markets exist in one of two states, trending or ranging. This is very important. In trending markets, price is making consistent progress in one direction, creating clear higher highs that are higher than previous highs, otherwise known as an uptrend, or lower highs, lower lows, downtrend. In a ranging market, something that I personally prefer to trade a ranging market, price is oscillating between defined boundaries without making sustained directional progress. The structure is essentially horizontal rather than diagonal. Understanding which phase you're in is critical because strategies that work brilliantly in trends fail miserably in ranges and vice versa. It's very important to understand the market that you are in, because if you're using a ranging system during a trending market, you're going to get absolutely obliterated. And if you're using a trending system in a ranging market, you're going to get absolutely obliterated. So make sure you identify what the market structure is saying, identify what market you are in. Are we moving sideways? Are we moving diagonally up? Are we moving diagonally down? What market are you in? This will help you a lot. And then also taking it a step further, looking at, these videos are recorded, taking it a step, and they're put on YouTube, and taking it a step further, something which is also very important, is looking at it in multiple time frames. What I like to do, is I like to zoom out on like the 4-hour time frame, look at what's going on in there. Look at the market structure in the 4-hour time frame. Then go down to the 1-hour time frame. Look at the market structure there. Then go down to like the 30-minute or the 24-minute. Look at what's going on there. Then go down to the 5-minute. Then I'm like, okay, the 4 hours trending to the upside. The 1 hour's kind of ranging. The 30 minutes trending to the upside also. The 5 minutes trending to the downside. You've got a good picture of what's going on in the entire environment that you're looking to trade in. Okay? This is very important. Okay. Trending markets are characterized by momentum and continuations. Pullbacks are shallow and brief. Breakouts from consolidation tend to succeed. Moving averages slope clearly to the upside for an uptrend, to the downside for a downtrend, and price respects them. Trend following strategies, buying pullbacks in uptrends, selling rallies in downtrends, work well. Counter trend strategies get destroyed as you're constantly catching falling knives or fighting rising tides. The key to trading trends is identifying them early, entering on pullbacks rather than chasing breakouts, and staying in until structure breaks. During a trending market, one of the best tips I can possibly give is not having a set take profit. Take profit. I said it earlier in the Discord, and I said it earlier for this trade right here, which obviously was a really nice trade. And that is, someone asked me, Max, what's your take profit? And I was like, my stop loss is here, but my take profit, I haven't got one. I'm going to take partials as we move up in the trend, and that's what I'm going to do. I'm going to slowly take partials, so then I can squeeze the most out of that move. That's what you want to be doing in a trending market. In a trending market, you want to try and catch as much of that trend as possible, and it'll probably go a lot further than you realize. So yeah, I think we were here. Boom. So yeah, ranging markets are characterized by oscillation and reversal. Price bounces between support and resistance like a ball between two walls. Another analogy for you there. Breakouts attempts often fail and reverse back into the range. False breakouts. Moving averages flatten and price drops through them randomly. In these conditions, mean reversion strategies work very well. Buying near support, selling near resistance. Taking profits quickly. Trend following systems get chopped up as you buy near resistance, the range top, and sell near support. Exactly wrong for these conditions. So basically, to keep it very simple, if we're trending to the upside, okay, we're trending to the upside, you want to get in on these pullbacks. Okay? Perfect. If we're trending to the downside, you want to get in on these little rallies here. Perfect. Makes sense. And then if we're in a sideways market, you want to just get in at the low and get in at the highs. Exactly like what has been done here. So this is so good because this has just happened on gold. So where was it? It was a different chart. So on this one here, yeah, it was back here. So during this ranging market, we were buying, we were selling in the high. You can see we're selling in the high and we were buying in the low. These were levels and these were trades that were given in the group. And then when we started trending, we still found this nice one as well. We entered really nice buys. When we started trending, we entered really nice buys to capture that bigger trend. And then here today, we can look here. We formed a new high. So we wanted to get in at the pullback. All of these concepts, which I'm going over here, we actively use inside the group to profit. Okay, perfect. So we'll go over this part. Let me know if that makes sense, though, guys, and we'll move on to the next part. And I hope you're enjoying this, guys. I hope it's not too laborious. I hope I'm trying to make this engaging. There's definitely some great value here, and I really hope it's pinpoint. These will get better as they go on, as I learn what sort of sticks, what doesn't stick, and from your feedback, we'll optimize it. As I really think, this bootcamp plus a clear explanation and some visual aids can really just take your trading knowledge to the next level, and that's what I really want to do. So yeah, happy to continue. All good. So the challenge in the markets, the challenge is that the markets don't announce when they're switching from a trend to a range, or vice versa. You have to read that from structure. Very important. When clear trending structure breaks, when an uptrend makes a lower low or a downtrend makes a higher high, that's often the first signal of a shift to a ranging market. When a range finally breaks with conviction, that's important, with conviction, so a lot of volume, and price begins making higher highs and higher lows, or lower lows and lower highs for a downtrend, that's your signal the trend has begun. The best traders are flexible, adapting their strategy to current market phases rather than forcing their favorite approach regardless of conditions. And look, I've been there 100%. I've been in those situations where I've got a system and I'm like, this is just the system, man. This is the dog's bollocks, okay? I want to use this in every single market at all times. And, you know, for maybe a few weeks, months even, it works perfect. But then all of that money from the market that I took from the market, I give it all back during a big trending run, or consequently in a big ranging market or something like this. So you need to make sure you're adapting based on the market. You know, if you don't adapt during these markets, the market will just chop you up and serve you in a soup or something. So make sure you're adapting to the markets. So let's move on to liquidity and how markets really move. Liquidity is one of those concepts which sounds really complex, but is actually simple once you understand it. Liquidity refers to resting orders in the market. This is important. A lot of people nowadays like to say liquidity like it's this cool thing, but liquidity it's just orders in the market. There's liquidity all over the chart. I think a common bad idea which is spread in the trading space is that liquidity is only above and below highs. That isn't the case. So you know someone, where's liquidity lie? Okay, it lies above and below lows. No, external liquidity lies above and below highs and lows. But there's liquidity throughout the market. It's how the market moves, you know, just orders. That's throughout the market. So there's external liquidity, which is liquidity above highs and below lows. Then there's internal liquidity, which is inside the market, below, like in between those highs and lows. Okay, there's liquidity throughout the market. It's the reason the market moves. Liquidity refers to resting orders in the market. Buy stops, sell stops, limit orders sitting at various price levels, waiting to be filled. Institutional traders who need to move large size required liquidity to fill their orders. They can't just market buy 10,000 contracts. They'd move price dramatically against themselves. Instead, they need to find areas where lots of orders are resting so they can fill their size at relatively stable prices. This is extremely important. If you're a big institution, okay, if you want to sell a bunch of apples, okay, and you just walk out to the street at 2 a.m. in the morning, it's going to be really hard to sell all of those apples, isn't it? Like, you're going to be screaming at every single bystander that walks past, okay? It's going to be impossible. But if you go to like a food market at peak time during the day, the sun's out, everyone's happy, those apples are going to go like crazy, aren't they? Exactly the same in the market, okay? If you're trying to trade like just as market's about to close, you know, there's not many people around, good luck getting those orders filled, especially for like, you know, big orders. There's not much liquidity there. Whereas if you're peak time, you know, New York's just opened, everyone's going crazy, there's orders everywhere, people are going to snap up those orders like there's no tomorrow because there's a lot of liquidity, there's a lot of market participants, and those market participants are big, okay? So very, very, very important as well. Hello, DZ. So where does liquidity pool? It concentrates at obvious levels, round numbers, 1.2, 100, swing highs and lows. Stops get placed beyond these, and previous support and resistance. Think about it. Where would you place a stop if you were long from 1.195, probably below the recent swing low at 1.9, right? That's not unique. Thousands of traders do the same thing. This creates a cluster of stop losses, orders just below that swing low. Those clusters of liquidity are attractive to institutional players who need to fill large orders. And institutions, depending on the market, is more common, but institutions, a lot of time, they can make things look very attractive. You know, they can form those nice higher highs and those little liquidity grabs and all of those concepts which people preach about on YouTube. They can, you know, form those nice little patterns, and it's all there in an effort to just pull that liquidity so then they can wipe it all out on a really nice big order. Boom, they're filled. They're sitting back looking pretty. Okay, so definitely keep that in mind. This is why price often seems to hunt stops before reversing. It's not manipulation. It's not a conspiracy theory. It's simply institutional players sweeping liquidity. Price pushes below swing low, triggers all those stops, which become market sell orders, adding to downtrend pressure. Institutional buyers absorb that selling to fill their large orders, and then price reverses sharply uptrend. Retail traders see this as the market stopping me out before going in my direction. Institutional traders see it as we need liquidity to build our position, and stops below that swing low provided it. This is so this is what most people see it as, and you can understand it, and it makes sense, and it does happen. But something to keep in mind is at the chart, okay, if we pull a fixed volume profile, which shows the volume in the market, then above the highs and below the lows, there's actually not as much volume. So if you're a big institution, below the lows and above the highs, there's not actually that much volume. You've got more chance filling your orders actually in the middle of the zone, because that's where the most liquidity and most orders are, like the point of control. That's something to keep in mind, which kind of contradicts that. But, you know, trading's about, what's the word? Paradoxes. Things don't make sense. Understanding liquidity helps you place stops more intelligently. Don't place stops exactly where everyone else does, just below the obvious swing low. Either accept wider stops beyond the liquidity sweep zone, or use tighter stops with the understanding that you might get stopped out on a liquidity sweep before price goes in your direction. It also helps you anticipate price movement. When you see price approaching an obvious liquidity pool, cluster of stops beyond a swing high, for instance, there's a reasonable chance price will push through to grab that liquidity before reversing, even if the longer term direction is the opposite. Okay, so that's liquidity. A lot of people spend a lot of time, going over it. It seems like this magical concept, but liquidity is just orders. Okay, most people are going to place their orders, above and below swing lows / swing highs. Majority of orders get filled actually internally, so that's where most of the liquidity and most of the orders actually are. They're internal, so it's completely the opposite of what everyone else says. So yeah, that's liquidity. It's not special, it's just basically orders in the market, how easy it is for institutions to fill their orders. So guys, now we're going to go into, now we've gone over the resource material, we'll take a quick glance at the summary. I think we've covered everything quite nicely. Now we're going to get into the quiz. So this is the important part. Make sure you write this down, leave your answers in the comments, or type them in the chat, or write them on a notebook, or write them in your notes on your phone, and we'll go over the answers after we've gone through the quiz. And please let me know how you've done. The questions which you get wrong, make sure you ask about them. Okay, ask in the Discord, ask me, research them. Find out the answer. You don't learn anything from the questions you get right. You learn everything from the questions you get wrong. Okay, very important. So let me know in the chat now if you're ready for the quiz. This is the most fun part of the boot camp. I really like doing the quiz. Let me know and we'll get straight into it. I've run out of water there. Darren says yes. Perfect. So, question 1. A sequence of higher highs and higher lows indicates a range, a downtrend, an uptrend distribution. Again, question 1. What does a sequence of higher highs and higher lows indicate? Range, downtrend, uptrend, distribution. Let me know in the chat. And also write them down, keep track of your answers, and then we'll go over the answers at the end. Okay, let's go into number 2. 2, true or false? Session liquidity can materially change execution quality. So, session liquidity can change execution quality. What happens if there's a lot of liquidity? What happens if there isn't much liquidity? Okay, if you're trying to sell those apples and you're trying to sell them at midnight down the street, is that going to affect how you sell those apples? Compared to if you were to sell them at like a fruit market during like peak time on a sunny day. Okay, let's go into number 3. Euro USD, quote 1.085, 1.0852, has a spread of what? 0.2 pips? 2 pips, £2, 0.02 pips. Again, if you don't know the answer, give it a go. What is the spread on this Euro USD pair? Okay, let's go into question 4. Which overlap is typically most liquid in FX, in Forex? A, Asia London. B, London New York. C, New York Asia. D, none of them. Which overlap is most liquid in Forex? What are the two most important sessions in Forex? I think, yeah, everyone's doing very well, by the way. Really nice. Okay. A stop at 1.08 fills at 1.0784 in a fast move. This is positive slippage of 16 pips, negative slippage of 16 pips, no slippage or spread widening. So you've wanted to get out, let's use a different number. You wanted to get out at £100, but instead you ended up getting out at £80. Okay? Because price, it moved very quickly down to that level. What is that called? A positive slippage of 16 pips, a negative slippage of 16 pips, no slippage, spread widening. Then we'll go into number 6. So, one advantage and one risk of market orders versus limit orders in thin conditions. So, what's one advantage of a market order during thin conditions, and what's one advantage of market orders during thin conditions, and what's one risk of a market order? So this is important to know. During thin market conditions, so low liquidity, what's one advantage of a market order and one disadvantage of a market order? So what is a market order? What does it allow you to do? What's the pros? What's the cons of it? Okay, you can write your answer in the chat, note it down, and then we'll go over the answer. Again, think about it. Market orders, what do they allow you to do? Okay, what's the downside of them? What's a drawback to them? Define a simple rule you could use to label trend versus range. That's number 7. Define a simple rule you could use to label a trend versus a range. We went over this in the first part of this bootcamp. Okay, question. You can pause this, by the way, at any point to make sure you get a good answer. Question 8. Name one, and if you want to just say out loud. 8. Name one practical adjustment to reduce execution risk during major news releases. Name one practical adjustment you can make to your system to reduce execution risk during major news. Okay, that's number 8. Number 9. This was from the first lesson of the bootcamp. Backtest expectancy equals 0.4R. Live slippage equals 0.1R. And it costs 0.05R. What is the realistic expectancy? So, you expect to make 0.4R on your system. Slippage is 0.1R. And the cost of the trade is 0.05R. What is the realistic expectancy? Okay, nice job. Okay. So, final question. List 3 things that directly control slippage and spreads. Name 3 things which directly impact slippage and spreads. Okay, again, you can pause this at any point. Let's go over the answers. I do have to really get a move on now. Okay, so question 1. Question 1, C, uptrend. Higher highs and higher lows defined an uptrend. Question 2, true. Liquidity affects spread, slippage, and fill quality. Question 3, spread calculation. B, 2 pips. So this was 0.0002 difference, 2 pips on Euro USD. Question 4, The most liquid FX overlap is, of course, London, New York. Participation peaks during London/New York overlap. Slippage type, negative slippage, 16 pips. Stop filled worse than price due to a fast move. There wasn't enough liquidity to fill at the price you wanted to fill at. Market versus limit in thin conditions. Market orders ensure fills, but risk worse prices and slippage. Limit orders control price, but risk no fill. So when you're marketing into a position, you guaranteed get filled, but you could get filled at a worse price. A limit order means that you're going to get filled at the price you want to get filled at, but you might not get filled. Price might not come to your level. Question 7. Your trend versus range rule. Example rule. Uptrend. If price makes a higher high and a higher low with the last swing low intact. Range. If new higher high and new higher low for swings and oscillation moves. So how to identify basically a trend is higher highs and higher lows, or lower lows and lower highs. How to identify a range is basically new lows and new highs every which way. Question 8. News execution adjustments. Pause new entries 15 minutes before tier 1 news. Widen stops only if plan allows, or use limits after spreads normalize. Normally, just stay out of news 15 minutes before, 15 minutes after. Let the market do its thing. Let spreads go back to normal, and then you can resume trading. 0.25R for this one. I saw Graham in the chat for that. And then checklist items to control spreads/slippage. Trade only in liquid sessions, so London, New York. Avoid news minutes. So basically avoid trading news. Prefer liquid instruments. Trade major pairs instead of minor pairs. Use limits at levels. So instead of marketing in at a level, set a limit order so you won't get messed up by slippage. Predefined zone widths. Place stops beyond obvious liquidity. So then you're not part of that liquidity grab. Everyone else gets liquidity grabbed, but you're still in the position. Okay? Key takeaways. Structure equals higher highs and higher lows for an uptrend. Lower highs and lower lows for a downtrend. Liquidity drives costs and execution. The lower liquidity, the more expensive it is to sell. Just like at a, Sotheby's auction. Okay, the Sotheby's, I think it's Sotheby's, it's like one of the biggest auction houses in the world. They sell extremely expensive and very difficult to obtain items, but they take a ridiculous commission on everything sold. Why do they do that? Because that $20 million car, that $50 million artwork, it's not a very liquid market. There aren't a lot of those moving around. So it's very difficult, even though it's very expensive, it's very difficult to find buyers and sellers for that particular product. So they can charge a ridiculous amount. Whereas when you go to the supermarket, okay, that's the very, very low because there's so much buying and selling, like apples and oranges. There's so many changing hands that, they don't have to charge a ton, okay? And then account for spreads and slippage in your expectancy in your system. So when backtesting on non-live data, keep in mind that data which you've accumulated from backtesting isn't actually the data that you will see during live price action because of things like spreads and like slippage. So guys, you can get this full bootcamp in the private group with obviously everything else, signals, analysis, courses, community, everything like that. We're going to make the bootcamp better and better and better every single day. I want to make it as engaging as possible with, pictures, more quiz questions throughout. So it's more, again, engaging for you guys. So it's easier for the information to stick. And that's what I want. So if you've got any feedback, any ways we can make this bootcamp as engaging as humanly possible so the information sticks more, then let me know. I've made it as engaging as possible. Hopefully you picked up a few new things. And yeah, guys, take care. See you all in a bit. See you in a bit, Graham. See you in a bit, Darren. See you in a bit, John, DZ, Chris, John, Sam, Darren. Take care, guys. Hope you enjoyed day 3.